from the morning reading. The SPY forms a doji, the SPX a hammer. Buyers appear at short-term support. Stocks rise. 6 of 9 sectors moved higher on Wednesday. XLE, XLB, XLI were the strongest sectors, while XLY was the weakest sector. Oil rose $3.04 at $32.75. Breadth strengthened as advancers led decliners 1.77 to 1 on the New York Stock Exchange, and decliners led 1.05 to 1 on the Nasdaq. Stocks have made it to the 2-week threshold. The S&P bottomed 10 days ago, a window within which many bear market rallies tend to fail. Making it to 10 days doesn't mean there's an all-clear signal, but it has been a good sign when stocks were as far above the low as we are now, even though the gain is modest. If stocks were closer to the low by day 10 of the rally, then there was a higher likelihood of seeing an imminent new low and generally weaker prices going forward. Financials enjoyed one of the most notable reversals on Wednesday after being down more than 2% during the day and trading at a new low, except for the bad opening from August 24th, then reversed enough to close higher on the day. Prior instances of reversals like Wednesday have had a consistent record of proceeding upside follow-through in the weeks ahead. Wednesday's collapse of the US dollar provided fuel for gold and the miners. That caused a big spike in optimism, reaching 96 on the GDX fund. In that fund's history, whenever the optimism index reached 95 or higher, 3 days later, GDX was higher only 31% of the time, averaging a minus 1.5%. There have been signs of long-term bottoming forming here, but short-term, it is difficult to buy into something that is showing extreme optimism. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:23 a.m. Central Time, and I am recording this in preparation for the market day of February the 4th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and go to the morning report. And you can see all 4 broad market indices are pretty much wrapped around scratch at this time. At the time of this cut, I should say. Crude oil is also just below scratch. The one that's moving is the euro. The euro's up almost a full percent. Bonds are down about 1/3%. Gold is up about 0.5%. In overseas action, you have China up about 1.5%, Hong Kong up about 1%, Japan going the other direction, down nearly 1%. Germany's right around scratch, United Kingdom up around 1%. In terms of macroeconomic reports for today, we're starting to get into some of the more important stuff of the week. We have the weekly variety of the unemployment claims, also productivity and labor costs, and factory orders month over month, and the nat gas storage. And what I was leading up to is tomorrow we have one of the big 4 reports, and the monthly employment report will come out. You also will have trade balance, and that will be it. Consumer credit will also be tomorrow. Relatively minor report there. Big one, though, is the employment change and the unemployment rate and so forth, all that stuff with the monthly employment report. That will be a big deal, so be ready for that. In terms of current volatility, obviously yesterday was a pretty interesting day. When it was all said and done, no standard deviation move in terms of close to close. We pretty much ended up right back where we started from, but intraday was much more interesting than that. Short-term VIX is right now at a 22.35 skew, below the warning level of 125, so pretty benign there. IV percentiles also fairly benign on all 4 of the indices, with the S&P at a 32, the Russell at a 42, the Nasdaq at a 40, and the Dow at a 39. Let's go to the charts, and you see on the SPX, look at that big old reversal. That's pretty significant tail there. And there were a number of keys to this. Certainly the dollar was a big part of this. But to break through, and we talked yesterday about a couple important levels. The first one, of course, was the low of this Friday candle. It broke through that. And then the next one was the low of this range and that we had for about 5 days here. And it came down and just got to the bottom of that range, and the bulls came in force. I was watching my day trading charts at the time, and it was obvious. It was really obvious. We came down, tapped that number, and immediately energy and momentum came in, and we took off from that low. So it was a pretty obvious indication that the bulls have strength in this area. So while we're still in this kind of relatively weak pattern, this big market that's range bound and something of a transition market in the big picture, you have to say that there is clear evidence that the bulls are willing to support this area around, we'll call it 1870 or so on the SPX. So until that is violated with a close below that area, I would say that there is some confidence that you should have that the bulls are willing to support that area, because it was very, very obvious yesterday. So where does this leave us? We've got what might be a higher high here, but we're looking for, something of a lower, or should say a higher low, and it's more like a similar low at this point. So we're still in kind of this mess in terms of projecting the short-term future. Really, we're very, very, very neutral, and it's about as neutral as it can get with, the bulls having a hard time really getting any action above these highs, and yet um, the bulls also being able to demonstrate that they're willing to support this area here. So till something triggers us to kind of get moving from this area, we're very, very neutral. The Nasdaq, similar pattern, a bit more of an undercut yesterday. Also ended up negative, so there are some differences on the Nasdaq. Very similar pattern on the Dow, though more of a green body. It's not a doji there. And on the Russell, again, a doji. So volatility, you see we're still very high for bullish activity. So that's something of a warning. And I've been watching the bonds very carefully, and you saw the bonds, have clearly broken out over this swing area here. So a little bit of a retracement yesterday on the bonds with that counter action, inverse action going on in equities. So far today, up just marginally on the bonds. When you look at the TLT again, a break of that former swing area, and also continue to watch utilities. This has gone parabolic. If you're in utilities, you might want to start considering some protection modes to be able to protect this move, or perhaps even tightening up stops and looking for to protect this move, because this could, as you see here, you get this parabolic move, and it's in this channel, and then it even breaks out of the channel, goes parabolic in this time frame here, and then just comes crashing down, and you give it all back. When you see a parabolic move like this, then you need to kind of look at protecting that. On the flip side, if you're a long-term holder, you could always get in with a re-entry commission away. It's not a big deal, but guarantee you your commissions would be nothing compared to having this back up, some 10% or something like that, which you could very, very easily do. So just kind of keep an eye anytime you see something that goes parabolic. I think that's enough for that. Let's go to the daily report. So we continue to be market in transition as I describe it here. I've got this back into phase one with the action of the last 2 days. Bear flag, toe in the water with selling puts and reduced stock positions. Remember, this was phase two. just a couple days ago, but this shows you just how tenuous and neutral this market is. It flip-flops back and forth, giving signals one side versus the other. Some of the more stable signals are the portfolio investor posture. The IBD is in confirmed uptrend. I say stable. You know, we've had 13 confirmed uptrends in the last 13 months, and not a one of those has managed to achieve any significant bullish run. So that again is that market in a range, market in transition. The accumulation distribution score on the S&P is a D plus. The Nasdaq also D plus. GMI index is a 0 out of 6 with a sell signal since December the 10th. That author remains happily in cash. Decision point scoreboards, no change from yesterday where we introduced the new PMO signals on the short term. In terms of intermediate term, we are bullish, just very, very slightly bullish with a very bearish sentiment line. So we're expecting that bearish moves can have more of a pronounced move. In terms of position sizing opinions, no changes here. 100% on the one, 50 to 75% on the other. That intermediate term market posture is well up over 20. I said mildly, just barely bullish. Well, that's because we've had this flip-flop going from bullish to bearish, back to bullish in recent trading days. So this is a very, very kind of flat line for the most part right now, and certainly is not indicating any kind of strong move one way or the other. Very, very neutral in its stance. Hedge warning status, we've remained level 1 through the recent flip-flops here. The hedge risk levels seem to be, at one point elevated, and yet at the same time, it doesn't seem to be terribly scary. There's not a lot of red on the various warnings right now. We seem to have strong support by the bulls at certain levels. So while we're certainly not super optimistic bull, we're also not super scary bear at this point. It's very, very neutral in its stance. You can see some of the specific warnings that are still in play. Market in decline, sharp increase warning, VIX futures up over 18. We have on the distribution day count, this has been climbing relatively quickly for so early in a new confirmed uptrend sequence. S&P is already at a 2 and Nasdaq at a 3, though neither one of those are at warning level yet. One other warning area is the fact that the next week out expected move in the SPX is a relatively high 55. And we have 3 of the 5 key intermarket risk aversion indicators currently flagging as risk off. Fear and greed index at 24, so we're still extreme fear here, though that's a bit up from the lows where we were a week ago. In terms of special opinions, no changes from what we had yesterday. Borderline acceptable for new covered calls and put selling positions for novice traders. And you certainly want to consider a number of these defensive postures that you can take to be able to put that toe in the water as we described at the top with that market phase 1, and yet at the same time maintain something of a buffer for your positions until we get something much, much more solid in terms of a bullish trend. In terms of sector specific, you can see again utilities and consumer staples are the only two that are holding up really well, and they are very defensive in nature. Telecom's usually a source of good dividends, so that can also be a source of some defensiveness. So on the flip side, look at retail, financials. Financials did have a lot of improvement yesterday, coming up off the bottom on an intraday basis. But in a lot of these higher beta areas are really, really suffering, and it's hard to get a healthy bull when you don't have the participation of some of those sectors. And indeed, you see energy put in a huge day yesterday, materials, telecom, utilities. So you had a little bit of a mix from the energy complex coming in, and this was probably largely related to the dollar move, big move in the dollar yesterday, along with, again, this focus on the defensive. Though I will say consumer staples were kind of a flat day for it yesterday. Okay, I think that is probably enough. We're a little late today. I've been playing around with the microphone trying to get those levels better. I'm not sure what is causing the problem with that, but anyhow, bottom line, I am aware and working on it, trying to get the microphone levels to be more appropriate on your end. Now, one of the things to keep in mind is that we do send out an email once in a while. It's a limited number of emails, but we send out alerts when the hedge risk level changes. We also send out periodic blog articles and other items of interest. If you'd like to get signed up to our email distribution, you just go to this to this web address, roll down that page just a little bit till you get to this button. Click on the button, you'll put your name and your email address. That'll opt you in. Also, as a result of doing that, you'll get a hyperlink that will provide a copy of my ebook, Portfolio Strategy. You can also use a smartphone to opt into the email system. Just text Falcon Global, all one word, to the 22828 number you see here. If you find what you're getting from here is helpful to your trading, subscribe to the YouTube channel, and that'll give you notice when content has been posted. And we're going to go ahead and move on. I'm going to just flip through these. If you see something you want to spend some time on, just hit the pause button. But we're a little late getting to publishing today. Disclaimers as always, hit the pause button if you need more time to review, and you see the full hyperlink for the full set of disclaimers. We'll see you back here tomorrow morning with the Falcon Global Market Preview.